Make Market Wrap part of your social network and never miss a thing.
Good afternoon, everyone, and welcome to Market Wrap. I'm Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for nearly 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. As I promised you earlier, today we go for our monthly chat. Every month and a half, we go and talk to Mr. David Ellison, president of FBR Fund Advisors, president and chief investment officer of FBR Equity Funds. Mr. Ellison is also the portfolio manager of the FBR Large and Small Cap Financial Services Fund and co-portfolio manager of the FBR Large Cap Technology Fund. Mr. Ellison, welcome back to Market Wrap.
Hello, Mo. It's good to be back.
David, it's nice to have you back here. Let's start with, it's been sort of a quiet month in the market. We saw the highs around in the S&P, if you look at it, somewhere around the 19th or so of January, and since then we came back down. Now we're starting to come back up. Is this a garden variety correction that we're seeing, or is this the beginning of something significant as far as the pullback is concerned?
Well, I think I'm looking at it, and I think the economy was pretty strong up until about Christmas, and then since then, or at least through Christmas, and I think since then the economy has looked like it's softened up here for a variety of reasons, and I think that's why the market's come down. So I think the market's going to follow the economic activity, and if the economy softens, the market's going to go down, and if the economy strengthens, I think the market's going to go up. So I don't think it has to do with interest rates or has to do with what the government does. I think people are looking at the economy, and it's very sensitive to that, and it has become increasingly, the market's become increasingly sensitive to the economy over my career.
So it is not all of this market news that we're hearing, well, the Democrats can get along with the Republicans can't get along with the Democrats. We've got this gridlock in Washington. We've got this problem in Europe with all the countries, Greece, Portugal, Spain, etc. You think that is secondary to the economy?
Yes, and I think the Greece thing is important only because it's a symptom. And to me, what's happening is people are saying, look, the excessive amount of debt is going to create less consumption. And either they're going to have to cut salaries or cut services. And so this debt level that's showing up in Greece, which is the same thing in California, the same thing in Massachusetts, the same thing in Florida, this is all going to, unless you write the debt down and start over again like you did with GM about 6 or 8 months ago, you're going to have lower consumption. And the market's saying, wait a minute, I don't like lower consumption. I want greater consumption. And on top of that, I think the big economic indicator here has been we have not seen an improvement in the level of jobs. The unemployment numbers, the weekly jobless claims continue to be north of 400 and almost to 500 there for a couple of weeks. And the market's saying, look, without jobs, you can't have a recovery.
So you think the biggest, you mentioned the economy is the one that's going to really dictate where the stock market is headed. And the one indicator that you're paying particular attention to right now is the employment data. Dave, isn't that a lagging indicator rather than a leading indicator? By the time we get the unemployment rates coming down, the economy is already going way ahead. So why are so many people, and you in particular, looking at the unemployment number as the key?
Well, I'm looking at it because, again, it's a weekly number, and I think that at some point, I guess to me it's just because we have so much debt in the system that without an improvement in jobs, you're not going to be able to either fund new loan growth or continue to service the debt that you have. People typically service their debt with their job, not with their savings account. And to me, without the improvement in jobs, you're not going to get loan growth. And I guess you're also hearing, when I talk to the small and mid-sized banks around the country, the loan demand just isn't there. Everybody wants them to make loans, but people actually have to apply for a loan first.
So there just isn't, the demand isn't there. So the banks are saying, look, we'd like to give the loans if there's some qualified people who would like to get the loans, but there isn't too many people that are asking for the money at this point
Correct.
in time.
And I think part of it is that we're in people are realizing that in the last 4 or 5 years, all the people that have blown up, whether companies, whether it be individuals, it's because they had too much debt and they lost their job and they completely blew up. And even people that have jobs are blowing up in the sense they can't make the payments. And you're hearing that, of course, across the country, subprime, all-day, liar loans, etc. And so I think people are just saying, look, debt's a bad thing. And they're going to use less of it for a while until they get comfortable that they can handle it. So I think we're in a deleveraging process for, I think, all the good reasons, because it's done a lot of damage to people.
David, when we're talking about, so you're really talking about a credit deflation, where we are seeing credit coming down and the credit bubble bursting. That's really what is happening around the world. And it went from the individuals to the corporations. Now the governments have taken over all the debt, pumped all of this money. But now people are saying, wait a minute, these countries or governments cannot continue to just issue money, print money, and issue debt without any consequences. What happens when these countries, their credit the bubble starts to deflate, like we're starting to see in Greece and Spain and some of these other countries?
Well, I think, as I said before, I think the big thing is it tells you that there's either going to be debt that's going to have to be written down, or there's going to be less consumption. I think part of the solution is Greece is to cut jobs, cut salaries, cut pensions, cut the amount they pay on health care, et cetera, like you see in this country, where the pensions and the health care that the public employees get, and then, of course, reduce the number of public employees, and, of course, raise taxes and cut services. So you've got less people making less money with less services and higher taxes, and that is, in a sense, bad for an economy that lives on consumption.
Right.
And so that's where I think it tells you something about what's happening, because what's happening to the goose here is happening to the gander. All these other countries are in the same boat, and the United States, to some degree, is in the same boat too. That we're either going to, over the next 10 or 15 or 20 years, we're either going to have to raise taxes or we're going to have to cut consumptions of those services, whether it be Medicare, Medicaid, Social Security, all the other parts of the budget. So we're coming up to that cycle. Greece happens to be hitting it first, and who's next is who knows. But I think the same thing is happening, as I said before, in this country with, let's say, California, with Florida, with Arizona, with Massachusetts. They all have budget deficits, and they're going to make those stark choices. They're either going to raise taxes or cut services.
David, but that is politically, right now no one wants that pain. No one is willing or even thinking about their Medicare being cut, their Social Security being cut, their pensions being cut. That is not even on the table right now. All people are thinking is, look, how can I get some more from the government, and the government will come and bail me out on whatever we've got to do. What happens when that starts to happen? Will that be politically palatable, or are we going to have some tremendous political upheaval?
Well, I think again, the solution probably is going to be hopefully something down the middle. They're going to cut a little bit here, and they're going to raise taxes there, and but I think the real big question to ask, and I don't think anybody has the answer, is why are we in this situation? Is because why is there suddenly this significant amount of stress financially across the entire system, including this country, as I said, California, you got Greece, and now you got the euro, and who knows what's happening in Iceland and Ireland and all these other places. Why is it happening? Is it happening because the service level is too high? Is it happening because interest rates are too low? Is it happening because there's too much inefficiencies in the government, or their tax rates are too low, et cetera? So I think there's a tremendous amount of lack of knowledge about why it's happening. It's sort of like, something's happening to us and we don't understand it. And I think we all think we understand it, but I think at the end of the day, there's a lack of understanding. So if Greece, for example, if Greece runs into trouble, does that really affect us? And people are trying to sort of create these little pockets of, well, it doesn't bother me, so I'll do something different. So I think that we're all in this together. We're a world economy that trades with each other. The currencies are ultimately linked. And if there's tremendous unrest in Europe, it's going to affect us, and so on and so forth. And so we all have to assume that we're in the same boat. So I think that's a new phenomenon that we haven't been dealing with for many, many years.
Mr. Ellison, I want to thank you for taking the time out of your busy schedule and being with us today. It's always a pleasure. Thanks again.
Yeah, you're welcome, Mel.